This is a supplemental video of my previous one where I screened every Dividend Aristocrat stocks. It just it felt short and I thought you'd need a clearer view of things. I just want to explain myself because I lost a subscriber and it felt knowing you only have this much and losing one or two is a huge deal for me. I care about my viewers, obviously. I only want the best for you and your money. I don't promote myself to other platforms like any YouTubers would. You search for your favorite stocks and you found me, and I'm grateful. When I screened those stocks, I did it in a very strict manner. I didn't have time to look into their financials one by one, all 65 of them, like I'd normally do in my videos. I used my first metric to do that for me. Now, I did say that if the stocks didn't pass that metric, it doesn't mean it's not a buy. It's just that we are following a very strict process here. And if I offended you or something about a disconnect from my previous videos where I said I'd buy this, I'd buy that, my explanation for that is because unlike from those videos, we looked into them one by one through their financials, explaining why those stocks trade at a higher PE. Now, we'll look into those 4 stocks closely through our 3 metrics. First one, MMM, 3M. This is my first metric. We want an EPS multiple less than 3. It's 1.45. We get this by dividing the PE by the EPS, because PE is the price you pay for in a company, not the price, which is only a reflection of their company's valuation. This metric tells us how much we're paying for the stock at the basis of their current earnings. I've included here the EPS and the OSN, or number of shares, over the years. We want EPS increasing and OSN decreasing. For old companies whose revenues at peak already, we expect them to be buying back shares to increase the EPS. If you're in it for the dividends, I'd say it's safe at 59% of their earnings. I want this below 60 personally. Next metric, we want to pay $1 or less for 1% of the money they're making. This means we want to pay 1 PE or less for 1% of their margins or yields. This metric tells us how much we're paying for the stock at the basis of their yields or margins. What you see here is revenues deconstructed. These are the expenses, the costs they use to make those revenues. Net income here is after taxes, free cash flow they generate off of those revenues. Values above are in billions of dollars. Below is in percentages of their respective revenues. I'll show you the relationship of the sales. I've only used 5 years of data here, but if you're looking to invest in these companies, use a higher time frame. I've also included here the revenue growth because they will still be making the same yields even with declining revenues. So it's important for these companies to retain their current revenues. Of the 4 highlighted values, we'll use the lowest yield to divide the current PE, and we'd get a discount of 0.92. This means the stock is trading at a discount. The purpose of this metric is for us to establish our entry PE for the stock. This third and last metric, we want to know our discount compared to when the markets have valued the stock before by looking at their historical PEs. I took the data from Guru Focus and Macro Trends. We'll use the lowest average historical PE to divide our current PE. Our discount is 0.82. The purpose of this metric is to confirm our entry PEs we've established in my second metric. Here's the summary of our 3 metrics. The stock is trading at a discount because it's trading at 1.5 times earnings, 0.92 times their yield, and 0.82 times their historical PE. The fair value is 160. This is EPS in my first metric multiplied by the lowest yield in my second metric. Here are my entry PEs and prices for the stock. I've included my safety of margin already into this. If you bought the stock at 140, I think you're golden. Just add more as it dips. Now I did this to other 3 stocks, McDonald's, TROW, and Ben. So we'll look at them very quickly. This is McDonald's. This is my first metric for McDonald's. Second metric, you can pause it though if you want to take a closer look at their numbers. My third metric and their summary. If you had bought the stock when the markets dipped at 220, I think you're in it. for the long run. TROW, first metric, second metric, third metric. The summary: TROW is a buy anytime, but there are still risks around, the war and all, but it's currently trading at a discount if you want to buy the stock. Next is Ben, my first metric, second metric, third metric, and to summarize, Ben is trading at a discount as well. Actually, the current price is all below my entry PEs. If I were to choose between TROW and Ben, I'd choose Ben. One, because of their yields, it's higher. Two, is that they have a somewhat higher or stable revenues compared to TROW, meaning they may be charging more of those assets. I don't know. Look into their reports. Ben looks like a better buy than TROW.